Hey, welcome everybody to the Everyday Investor. Today I'm catching up with Jeff Royle from Islander. Jeff, you're a financial paramedic. So I'm keen to find out what that means. Tell me everything about what it is in the day of the life of what you do.
Okay, so our practice is perhaps a little different to regular mortgage advisor practices. So we tend to be when the banks say no, what the hell do I do? And so we are pretty strong in the non-bank or alternative lending market. And being declined by a bank, doesn't necessarily mean it's a bad thing. I mean, quite often it is, but it doesn't have to be. For some reason, we seem to be coming across a lot of self-employed people where perhaps their accountant hasn't done the best thing.
Yeah.
So that's leading to Mr. IRD knocking on the door saying we want some money. That's happened a lot actually in the last couple of weeks. And perhaps the biggest market for us currently are New Zealanders living overseas and wanting to buy something back home. So they're not coming back home because the reasons for staying overseas haven't changed.
Hmm.
But they want to buy something back home. So they may phone ANZ or ASB or something like that. Pretty much, they only use half of your salary if you're working in Dubai or working in London or somewhere like that. And so you fail on their servicing calculators. Whereas a couple of non-bank lenders will go up to 100% of your gross income, which obviously means you can borrow more money.
So you're obviously seeing a subset of the overall market compared to someone like myself, where I work in the more plain vanilla space, mom and dad upgrading, all that sort of stuff. So I'm just dealing with the mainstream big four Australian
Sure.
banks and a few others, whereas you're very much dealing in the alternative or non-bank space, like you say. So do you have experience on both, like mainstream first tier and second and third tier as well?
We do for two reasons. One is we have to. So if I'm using second or third tier lenders, the rules say I have to have an exit strategy. So the exit strategy is generally to a mainstream, ASB, ANZ.
Cool. Okay. And I guess you've touched on this already. There's definitely seasons, I guess, that you go through throughout the year where it might be tax time. Accountants haven't necessarily been proactive in terms of providing advice. They've been transactional, right?
Yep.
So there's that. And then there is probably an increasing rate of non-payment, right? People are falling into arrears more with their mortgage payments. Is that, are you starting to see that pattern on your end?
I am. I think there's a lot in the press about this. Um, a lot of comparisons back to the GFC. So just for clarity, at the peak of the GFC, the Reserve Bank reported that 1.4% of loans were more than 3 months in arrears. So they call that like a serious event. Currently, we're at 0.45%. It's still, it's affecting a lot of people. I have dealt with, I think it's 17 mortgagee sale scenarios since the beginning of February. I can't remember in recent times where I've had to deal with that many, and we can probably save about 60% of them.
Mm.
So yeah, there is hurt out there, and unfortunately, I don't think we're out of it yet.
And one of the other things that's going on is that even though the rate of non-performing loans is probably increasing, the share of business that go through mortgage advisors versus people going directly to the bank has increased quite a bit since the global financial
Si-
crisis as well, right?
Significantly.
What do you think is driving that? Because obviously I look at it from my perspective as well, and I kind of think of that, well, that's great. Of course, that makes sense, but it just takes a while for that message to get through, I guess. Or do you think that the banks have been trying to kind of shut down the areas of their distribution, which is not necessarily that profitable because they have to have fixed costs, obviously, to distribute their mortgages to borrowers, whereas
Mm.
going through mortgage advisors, it's a variable cost, right? So do you think that that's a piece and that's what's driving it? The banks are just trying to cut costs, or is there something else going on?
I think very much it's something else going on. I
Mhm.
think the banks sort of cutting back in many ways helps the advisor system, but I actually think it's more the public trust in the advisor system has skyrocketed. It's certainly the last 10, 15 years.
Mhm.
Regulation has been well publicised, and the
Mhm.
disclosure requirements are so high.
Hmm.
It's pretty hard to operate in this industry unless you're doing the right thing, and the right thing is doing the right thing by the customer. And I remember going to an industry function probably 2009, maybe 2010, and it was called the Roaring Forties, and that's when advisor, if you like, penetration of bank lending hit 40%. It's now 60 something. So to me, that's a testament of the public seeking, if you like, an independent view. And of course, you can go to the bank directly if you want to. Nobody's going to stop you.
Mm.
But would the guy at ASB, even if he knew that, I don't know, B and Z had a significantly better product, would he necessarily tell you that? And the answer is no, he wouldn't. Whereas as an advisor, you can look at somebody's situation and select the best lender, so bank, and then drill down into the best product. Commerce Commission came out with a report that or a draft report that expressed concerns that advisors were channeling business to a lender that paid them the most money. I have no idea where they got that from. And in fact, having had the conversation this morning, I don't think they understand where that came from. But the reality is, it doesn't happen.
Hmm.
Banks, within reason, pay pretty much the same, whether it's ASB, whether it be ANZ. The way they pay may change. So
Hmm.
Westpac, for example, pay a much lower upfront commission to an advisor, and then they pay a monthly, what's called a trail fee. ANZ pay a flat rate. There you go. Thanks for the business. If you look at the dollar numbers, they're pretty similar. Advisors are very much product driven, policy driven. Where is the best fit for that particular customer?
So I guess the draft allegation, was that mortgage advisors will direct business to where they get paid the most, which of course is acting sometimes against the client's best interest. I say sometimes because, like what you just said, sometimes they have no options. It just so happens to be that the bank that we send it to might calculate the commission a slightly different way, but that's got nothing to do with the selection that we sometimes make. But by the way, we hardly ever get to make that selection because sometimes there are no other options, right?
Well, certainly in the non-bank space,
Yeah.
quite often there is only one. There is one solution. In the bank space, there is a lot of competition,
Yes.
and bank policies, as we all have the policy books and the policy guides, and then they change them.
Yes. That's
And
right.
it's a real mission sometimes keeping
Yeah.
up with all the changes.
Yeah. Now you mentioned regulation before, which has definitely influenced the trust piece. It's skyrocketed trust in my view.
Yeah,
Also, I think it's probably more of a generational thing. As younger people kind of come in, they look at things for as they are today, not how they always have been. And so I think there's
correct.
probably a little bit of that as well. That's just a shift that's going on. But like over the last 5 years, there has been a lot to deal with. A lot of people, a lot of advisors have had to basically go back to school even though they might be smart and experienced and qualified already. They have to go back to school. They have to get different qualifications. They have follow a different process, make sure they're actually following the letter of the law in terms of how they disclose fees and their process and the complaints process and the privacy process, processes for everything, right? From a business owner's perspective, from an advisor's perspective, I know you head up iLender, so you see you're all over all of this sort of stuff in terms of the impact of folding this regulation and new processes into your business. Would you say that you were probably achieving the same outcomes before this regulation came along? And therefore, would you say that most of the regulation that has been introduced, not just directly to you as an advisor, but indirectly through the banks that you now have to be a part of in terms of compliance occasionally, is
Mm.
that is that expensive? Is what I'm driving at. Like, is it
Okay,
who
okay,
pays the
yeah,
cost of this regulation?
yeah. I guess it's like any industry, isn't it? At the end of the day, the consumer, which is you and I,
Yeah,
pay. Um, a lot of the regulation, I guess, formalised what most of us already did.
yeah,
Um, and the regulation is all about putting the consumer at the centre of your business. I've always believed for the last 30 years, if you don't put a consumer at the centre of your business, you probably won't have a business for very long. So all it did was formalise good business practice. Compliance costs have skyrocketed. And the other thing that skyrocketed, which I find interesting, is we've had all this regulation. The bar to come into the industry is now quite high. The monthly cost, if you are a one-man band advisor working from home, it's about $2,000 a month just to stay in the industry. I can't think of too many other industries where you've got that kind of cost burden. And a big part of that is PI cover.
We're talking about professional indemnity insurance, which we have to pay for once a year, which covers us for what as advisors?
Bad advice. So if we give somebody bum advice, or we actually don't, we sit on an application and there is a financial loss to a consumer, a contract falls over or something like that, we have that covered behind us. Although it's not a regulatory requirement, it's actually a commercial requirement. As far as I'm aware, there have been no or minimal claims for mortgage advisors on PI schemes. We've got all this new regulation and all this disclosure and all this compliance, and yet my PI 3 years ago was 2,800, and last year was 8,950.
Oh, you got a
Um,
bargain. Mine
you
was like
know,
18,500,
well, there
Jeff.
you
You're
go.
getting a bargain.
Bargain. Yeah. So with no claims history, not just for ourselves, we've never had a claim, but as an industry,
Right.
there just aren't claims against mortgage advisors, and yet the PI cover's gone up so much. So we've had massive increases in compliance costs. That's actually driven, I think, good practice. There's been like a uniformity as to how we all operate.
Got it. Now, you mentioned before, well, probably closer towards the start, that you don't know where it came from in terms of the Commerce Commission's perspective, I guess, that they had at the beginning of drafting that initial report around this understanding of the advice business and this assumption that advisors will only ever recommend options where they get paid the most. And when I was doing a little bit of research, and this isn't something new, I've known about this for a while, but I just went back onto a certain website, Mary Holm. Mary Holm, really, really
Mm.
well respected financial commentator. Really, really good perspectives that she puts out there regularly in the media. But on her website, when it comes to financial advisors, and she's giving some really practical advice on how to choose financial advisors, she talks about commissions. And she has this statement that says, if the advisor is paid by commission from a provider of financial products, they will be incentivized to receive the highest commission rather than putting you in products that are best for you. So there's one place where maybe this misconception has come from. What are your thoughts on that?
Well, it's just not true, is it?
I don't think so.
I'd love Mary. Certainly, the guy at Commerce Commission this morning, and then there was a report in interest.co.nz last
That's
week,
right. David Chesson. Yeah.
yeah, and I challenged him,
Massive.
and then I got an hour's interview with one of his reporters, and I said, show me the
Mhm.
evidence. Where is it written
Mhm.
that one bank pays significantly more than another? And they can't, because it just
Mhm.
is not the case.
This is where it comes down to the fact that a lot of the people that are in the regulation industry, which isn't the financial advice industry, they
Very
don't
different.
actually, yeah, well, they don't understand the business that they're in charge of regulating. But what they do understand is how to enforce rules and how to look to optimize rules. They're completely different industries which they're charged to regulate. And then that filters through to those in the media, which obviously will hear stories from the fringe that might be quite emotionally triggering and appealing to the audience that they're trying to serve. And so I think what happens over time is you get this froth or this stirred up minority view just because it makes a great story, but unfortunately it goes counter to that trust thing, doesn't it? Like, we've
It
done so
does.
much work to build up trust, and now it gets crashed often by those that are in charge of actually trying to just ensure that there's a level playing field and make
Mm.
sure that no one gets harmed, right?
So the Commerce Commission kept banging on about price. So in our industry, let's talk interest rates. So it's incumbent on the advisor to get the consumer the best interest rate, and that just simply is not the case. If Bank A is offering, I don't know, 5%, but actually you don't qualify, and Bank B is offering 6.5%, and you do qualify, well, what's price got to do with it? It's criteria, it's matching the best possible price. That doesn't necessarily mean the lowest, it's the best possible, with the
Mm.
product and criteria of that particular lender, which then is in alignment with whatever that consumer wants to do. Then that led into a conversation about banks pretty much now insisting that when you go to refix your loan, they want you to use the app on your phone. There's no advice process. So even as an advisor, if I've got a customer who say with ASB, and they ring me up, or I ring them on review, and it's, oh, my rate's due next month. What should I do? I might say, well, look, if I were you, I would perhaps only refix for 12 months, something like that. Okay, so that's the advice process. What happens next is I can't enact that advice process. The consumer has to go to their phone, hit the go button on the phone, and what I have to do is ask them to send me a screenshot of what they've done, because I don't know. So in my notes on my customer file, I might say recommended 12-month refix. Unless the client can send me a screenshot, I've got no idea. I have no way of telling.
So that exposes you to a significant amount of risk. But what you're saying as well is that there's price, and then there is the best deal. What's the best price? What's the best deal? Not always the same scenario, because it doesn't matter what it is. If
Definitely
it's not on
not.
the menu, you can't have it, right? And I think that's what ultimately we don't have control of as advisors, is the price. Like what you're saying with most banks, is that there'll be a digital offer. I tried to actually, ironically, I tried to go to the Commerce Commission with a concern that I had as an advisor on behalf of one of my customers who received a digital offer which had this little blue ribbon icon right next to it, almost implying that it was the best deal
That
out
was the
there in the
right thing to
market.
do.
And
Yeah,
they
yeah.
still do that, right? They still do that, and it's like
Yep.
they're untouchable. And it is, in my view, somewhat misleading when they are excluding independent advisors who have the ability to present other options which might be more suitable to them. It doesn't
Mm.
seem to be super competitive when we're not allowed to have that interaction with customers, and they just want to have the easy, just select the button and off you
Yep.
go type conversation, right? But what
Yep.
we're also implicitly saying is that the real value in financial advisors or mortgage advisors here is in getting advice, because it's the advice that saves the money. It's not at the cheap interest rate for 12 months.
Absolutely
I'm
correct. And
biased.
no two and no two and no two people are the same. Financial literacy in this country is rubbish. It's not taught in school, it's not taught in college, and it's almost the only financial school that most people have is the school of hard knocks. Yeah, you make a lot of mistakes, and I'll put my hand up. When I grew up, there was no financial literacy and all that kind of stuff. So I think increasingly the demand on mortgage advisors is increasing. I believe in Australia, I think it's 75% of bank loans go through the advisor channel. I think it's
Yeah.
something like that. I believe the UK is 80, and I
Mhm.
think I think the US is like 90%. That's great for us now, because it means we've got a way to go, but it also means that those countries perhaps are a little bit more mature in their financial journey than we are here in New Zealand.
Mm.
So if we repeat what's happening over there, then the public are engaging with us more.
Mhm. Do you think though that I got to be careful with what I say. I get paid by the banks. How's that for a disclaimer, right? So and so
Yeah,
sometimes you do as well, right? So we need to be careful with how we say from a commercial perspective. But in your general view, how do banks view mortgage advisors?
really well. And I think that's demonstrated in the quality of bank staff in all the broker units that I deal with at the banks. I think if you talk to a consumer that goes direct to a bank, and of course that's your choice, I don't think you'll get the same outcome. The number of times we've had people come to us saying, I've been to my bank, and they've either stuffed it up or I haven't heard for 3 weeks or whatever it might be,
Mm.
come to us. I look at the application and I think, actually, the best place for you is your own bank. So I will make an application to their bank, and the number of times we've had declines turned into approvals, or we've got a response within 3 days and they've been waiting 3 weeks,
Yeah.
countless times. So bank engagement with advisors, I think, is really good.
Yeah. Okay. I want to go back to the conflict of interest piece and play a little bit of a devil's advocate as much as possible. Again, we're two advisors just agreeing with each other. So how helpful is that so far, right? We got to be a little bit more critical on ourselves. So let's
Okay.
just say let's just kind of come at this from the perspective of maybe just what is technically possible, right? Like we do have a conflict of interest in a sense in that if there was one job over here which was going to pay us $5,000 and then another job over here that we could do which pays us $500 and probably takes twice as long, then obviously there is a strong commercial incentive to spend your time on the thing that's going to generate the biggest result. At the very least there's a temptation, right? And so that's kind of like a picture of there could be one story which is exactly the same amount of work, yet we get paid a different amount simply because in one situation they might be borrowing 750,000 and in the other situation it's only $100,000. So we get paid very different amounts just based on their loan amount. So
Sure.
how does that not
Sure.
pose some sort of conflict of interest?
Well, I mean, the answer is it does.
Yeah.
And it's how you manage that conflict of interest. So in our practice, I'm pretty strong on this. So it's not quite first come first served. There is also depending on the urgency of that particular application. So if the deal for say 150,000 is a pre-approval, and the deal for 700,000 it's got a sale and purchase agreement attached to it, or there's an auction due. The reason for going for that, the bigger one, is because it's urgent. It's got nothing to do with the fact that it pays a
Hmm.
lot more money. And they're saying the other way around. You've got a pre-approval here for 600,000, but one's just come in 150,000. The auction's next week. That
Hmm.
gets the priority. So it's how
Yeah.
you manage. It's recognizing the conflict and then dealing with it.
I think it's a good point that you raise as well, is that it's not like the conflict of interest doesn't exist. The issue is how is that conflict of interest managed? For
Yep.
me, I'm very, very upfront that there are some situations that I will not get involved in, and it's because of commercial reasons. And
Yep.
if you don't like
Absolutely.
that, then great. I've got a fee-based option as well. So I'm not actually discriminating against anyone, but I also have to run a business. And so it's about how we manage that and we all have a conflict of interest anyway, right? Like no one's going to go to work without desiring to get paid. However,
Absolutely.
in some situations when you're self-employed, you kind of have to go to work on some jobs, right? Like you say, you might have to go to bat for somebody with a bank. I know I had to just yesterday, I had to go to bat for one of my customers that I'm not even working on their mortgage, but I had to go to bat with the bank because the bank wasn't assessing it properly. They'd missed something really obvious. And I'm
Mm.
not getting paid for that. And quite often people will assume that you do get paid somehow magically, and they're doing us a favor by coming to us for help. So there is a lot of this kind of wastage, I guess, and I'm saying that from a commercial
No,
perspective, not from a personal
I get
perspective,
that,
you know?
and we get paid by and large by the product provider. In my practice, a lot of our lenders don't pay commissions,
Mhm.
so we become a fee based transaction. Again, clearly disclosed up front. But one of the things that came out of why does the commission model work is it actually pays for the advice that we don't get paid for. And this is very much a rule of thumb. So for every 100 inquiries that we get, that translates to around 40 mortgage applications that come in. And of those, about 20 go to settlement.
Which means you
So
get paid.
yeah, so the 20 transactions we get paid on pays for the 80 that we don't. The commission model, it might be flawed. I've yet to find an alternative that might work where the vast majority of consumers are not paying for financial advice. And we all know how happy people would be if we stuck our hands out and said, yes, I'd love to arrange your finance for you. There's a fee note there for 2.5 grand. It would not happen. So whilst I do get the perceived conflict of interest with regard to you're going to go to the lender that pays you the most money, the reality is there is no evidence anywhere that I've seen that
Yeah.
would support that. And the reason there isn't any evidence is because lenders pay pretty much the same.
Got it. And we should probably just point out at this stage as well, there are attempts to make things simpler in our industry, which seem to make things more complex as time goes on, it seems. Like, for example, the regulation round that we've only just recently been through, where the terms mortgage advisor, insurance advisor, investment advisor were all done away with. And now we have financial advisor. And so we're all financial advisors. However, we might specialize in certain things. I'm a generalist, so I do a lot of things. You work in the mortgage space only. And so that's your specialty. Correct me if I'm wrong.
No,
Um,
it's correct.
Cool. And there are different subsets as well. So you will be working in the non-bank sector. So you will be charging a fee directly to the consumer, which sometimes will come through the product provider, but it's clear that it's your fee. Other times you'll get paid a commission from the lender. For me, I will be doing a completely different model again, where I'll have coaching products. I'll charge hourly rates, and that's for my advice. And then I'll receive, or I'll give the option of receiving commissions for implementation of financial products. And so there's very, very different models. But the key thing here is that with things like life insurance or any other insurance products, with mortgages, it is very unlikely that people will probably want to stump up with a several $1,000 fee to pay for the actual cost of delivering that advice. Whereas
Correct.
when you get over to, say, financial planning, completely different
Mm.
kettle of
Yep.
fish. You are paying a fee for that person's time and expertise. When it comes to investment advice, you are paying a fee, but that fee is attached to how much you're investing with them. So there's all sorts of nuances here, and we can't kind of approach this as all commissions are bad or all forms of remuneration based on volumes are bad, because it misses it. So like what you're saying, right? It's flawed. It's not perfect, but it is quite appropriate in most cases so that everybody
It
gets a
is.
chance of getting advice, right?
It is. If you get a loan offer from, let's say, I don't know, ASB, for example, is there anywhere in that loan offer that says what fees there are involved in that loan? I.e., if you've gone through a mortgage advisor, does that loan offer tell you what the commission is? They don't. In the non-bank space, and I'm just going to pick a lender out of the sky and say Base Corp Finance in Hamilton, on their loan offer on the front page, it says how much you're borrowing, what the interest rate is, what their fees are, what my fee is, what the monthly, weekly, fortnightly payments may be. If you repay the loan early, this is what the early repayment charge is. It's absolutely crystal clear on that document. You don't get that clarity with a mainstream bank. If you look at Westpac, anybody that receives an approval from Westpac, Westpac don't quote an interest rate at all. It says you've been approved, and it says you've been approved for 800,000 or whatever the figure is. It doesn't give you any idea as to what the interest rate is or options of interest rates, fees and charges, and stuff like that. You only get that once you're unconditional, which pretty much means you're locked in. So it's
Mm.
not a level playing field in my book between bank and non-bank. And the Commerce Commission were, I think they were quite surprised at that.
Which is really surprising, because you think that that would be the first thing they would do, would be to do the research around that. But whatever, who am I to say, right? I put it out there. But let me just pick up on something that you said. You mentioned early repayment charges or fees. I want to kind of bring up something more of a public service announcement more than anything else, but also it does totally connect in with what we're talking about here. A lot of borrowers, when they go through a mortgage advisor or even arranged life insurance, is another really good example. If a commission is being received, which goes to the advisor, which covers all of their time, like you say, you'll do 20 deals, um, which pay for the 80 that didn't go through that you had to work on as well. But that fee is out there. It's gone to them, and that's what keeps them in business. But let's just say something happens. You split up with your partner. You get really sick, or you go overseas and you sell your property within, say, 2 months. You repay the mortgage in full, or an inheritance comes, whatever the story is, but you repay your mortgage, say within a 2 year period. What
Yeah,
happens with that commission is that that commission then gets clawed back. That's the term, clawback.
yeah,
And that's the way that the bank who paid the commission recovers some of their costs for a situation that they didn't control. That was the consumer did that. But it's also a situation that the advisor didn't control as well. And they put the time in also to do that. And that's a business now that's had their cash flow interrupted because of a choice. So, anyway, that clawback is or has been traditionally absorbed by the advisor. And there's been an increasing trend for the advisors to then invoice the consumers of financial advice for some or all of that lost commission. I know we have a policy where we do that, have done for years. And
yeah,
it
with
doesn't
you.
go down very well because it's never disclosed by anybody apart from the advisor. And so if someone is selling their property early and they look at what are all the costs, the bank tells them what the costs are, solicitor tells them what the costs are, no one's reminding them what the costs are from the advisor. Do you feel like these clawback fees, if applicable, should be inserted into the loan agreements?
When somebody goes to repay a loan early, generally speaking, they'll phone up or email the lender to say, "Hi, whatever's happened, I'm going to be repaying my loan early. Could you please send me a figure?" And the lender will say, "Yep, your principal sum's 500,000. You've got a break fee of 8 grand, and you've got a discharge fee of $195, for example." What it doesn't say is, "Ah, we know that your loan came to us through an advisor, and we know that it was only done 6 months ago." So, what they don't say, and it's something I've been really banging on the drum hard about, is it should say that you may have additional fees and charges and you need to go back to your advisor. Now, I say may have because some advisors do not invoice somebody in that respect. But as you say, increasingly they do because simply because the costs of running our businesses have gone up so much. So we have to be very careful on how we run or manage our financial business. So I think there should be full disclosure on the part of any lender. Um, One does it at the moment. So Resimac Home Loans have it that if you repay your loan early or you request for an early repayment, there is a statement in there that says you may have costs. And of course, one thing that the costs will be a legal fee.
Hmm.
To discharge your mortgage,
That's right.
or if you're refinancing, a lawyer will have to be involved. So that is a cost.
Wow.
So I am very pro the clawback system. I think it keeps us advisors on the straight and narrow. For those of you that don't know why clawback was brought in, it was brought in to stop advisors placing business with a bank and then 12 months later saying, "Oh, Mr. Customer, there's a much better deal for you over there," which there probably wasn't, and we're going to refinance you. And that's called churn. And it was designed to stop churn, and it's done a really good job. So I'm pro clawback, but I'm not pro the non-disclosure by
Hmm.
lenders
Mm.
in this respect. And there is really clear guidance from the dispute resolution people. So as a consumer, if you have a grievance with a mortgage advisor and you feel that the mortgage advisor is not listening to you, or they've done something wrong, or you've had this nasty invoice for a clawback, you do have the right to make a complaint. It's all down to the documentation. So check your documentation when you
Hmm.
sign that
Definitely.
terms of engagement. When you sign that initial disclosure statement, which you will have done, was there something in there that says, in the event of early repayment of the loan, this is
Mm.
what happens?
So the reason why clawbacks were introduced is because of this thing called churn, which is when advisors would be tempted to swap you too soon, not in your interest, but really just to get an extra payment. But it
Yeah,
seems to have morphed into a cost recovery exercise where even just yesterday I had one because somebody on my advice had repaid their mortgage, and so the bank has pinged me for it. I just repaid a part of it, not the whole thing, just a part of it, because that was
Mm.
actually the best thing for them to do. But that advice literally cost me in time and in the form of clawback. Do you think it's right that the banks are kind of using clawbacks as cost recovery versus a preventative thing?
That's a good question. The banks are all about being the bank, anything to maximise on the dollar. So yes, I do think there is a cost recovery element to it. Um, I agree with the principle. I fundamentally disagree with the way it's done. So at the moment, just so everybody knows, um, the first an advisor knows of a clawback is that the bank physically takes the money from our account. We have no choice. It's gone.
Mm.
That's the first we know. What I've always said is there should be a warning that if you do a certain thing, and the warning should come from the bank in the form of just a couple of lines on the early repayment statement that you may have additional fees and charges. Just check with your advisor, and that's a soft conversation.
That's sometimes necessary. So let's bring it in for a landing now. Open banking. I just want to grab your general thoughts on this, just at a very shallow, superficial layer. Don't
Mm,
worry, but freedom for consumers to shop around, to change lenders without being pinged with these fees that we've just mentioned, or any other break fees, like if they're breaking
mm.
out of a fixed rate too soon, or stuff like that. Obviously, things get easier for consumers. They get better outcomes if they have more freedom to choose. Do you believe that open banking is something that's inevitable, that it's going to happen, or do you think that the banks will keep on digging
Mm.
their heels into the ground to resist?
It's a really complicated area because on the one hand you want freedom of choice, but with freedom of choice comes a price tag. So I don't think it's reasonable. And bear in mind, in this country, we actually have quite a small lending world. We're not America. We're not Australia. And generally speaking, say a 2 year fixed rate is what 1.5 to 2% below the prevailing floating rate.
Mm,
So one of the benefits of a floating rate is you can chop and change, overpay, do what you like.
mm,
That's because the bank's making a quite a nice margin on that floating rate in a relatively short period of time. Fixed rates in this country are generally funded by what's called the spot market. So the cost of money to a bank is then whatever that might be. They add a margin to it, and that's what they sell you and I as a 2 year fixed rate. If you then jump ship early and the bank cannot re-lend that money at the same as they lent it to you, they've made a loss.
what you're basically saying is it's the small market argument, right? Where we're a
It
small
is.
market, and if we want to be served by these financial institutions, we have to basically allow them to pillage, really, right?
Well,
To a
you have
certain
to allow
extent.
them. There's a big thing about banks make huge profits, and as we know recently, they certainly have. And I do think there's room for some negotiation. But go back to the GFC. Hundreds of banks worldwide
Mm.
went bust. And if you're in the US, UK, Europe, and you got affected by that, that would have hurt you significantly. No bank in New Zealand or Australia was stressed at that time because of the strength of the bank. So it's really important, I think, that we understand that banks need to make good profits. I'm not saying excessive or anything like that. There need to be good profits in order to cover that in times of need they are there. And obviously, we had the GFC, and obviously, more recently, we had COVID, we've had businesses stressed. The banks, by and large, I think have done a pretty good job of
Mm.
ensuring the longevity of the systems here. Room for improvement certainly is. Are they the big bad wolf? No, I don't think they are.
We probably want to vilify them a little bit, don't we? Is what you're saying?
Of
And
course, and I always joke with other advisors, because a lot of advisors come to me for deals that they can't do. So I become like a broker's broker, for want of another
mm,
expression. And we talk about relationships between the advisor and the lenders. With the banks, you're actually in competition with your lending partner. the bank would possibly, or certain people in the bank would possibly love it that the consumer goes direct. In the non-bank space, non-bank lenders by and large are not geared to dealing directly with the public. In fact, a lot of them are not licensed to deal
Mm,
directly with the public. So you actually have a true partner in
mm,
your lending partner. And this is where I think the digital refix has had a bit of a backlash. We are responsible for the entire piece, from the inquiry, how we place, why do we put somebody with a particular lender, why do we put somebody on a particular structure, and at the end of our involvement, it generates what's called an unconditional offer letter.
mhm.
Emphasis on the word offer. It's not a contract. And that produces what's called loan documents. And that is the contract between the consumer and the bank. So that goes to the lawyer and the client signs them and everything goes through. Do we see the loan docs?
Nope.
We don't, do we?
No.
So hang on a minute. We are legally responsible for advice contained in that document and we don't see it. I'm
Yeah.
responsible for a document I didn't see. You
Yeah.
know,
I guess what you're saying though is that because of the way things are currently set up right now, with some non-bank lenders like you would deal with mostly, you find out that you're not actually competing with a distribution channel. You're trusted as the distribution channel of that lender. And so that you're
correct.
being
Yeah.
equipped to actually handle all the things, which actually reduces the level of risk that you're taking to provide that advice, which means that people get access to advice better. Would you suggest that the normal mainstream plain vanilla banks should not be allowed to deal directly with consumers when it comes to new credit contracts?
No, I'm a great believer in freedom of choice. So for mainstream, let's call it vanilla business, mainstream business, there should be access multiple channels. So whether it be mobile mortgage managers, whether it be an online system, obviously we've got AI coming in. It'd be very interesting to see how that plays out. And then you've got third party distribution, which is what advisors come under.
Yeah, yeah, got it. Okay, so and I want to finish up just on any good news stories that you can tell us in terms of just pick a work story, right? Like pick a work story where you've helped somebody through a really difficult spot that kind of made you, apart from just getting a bottle of wine, kind of made you feel really good about your job.
So recently, a couple of guys, first home buyers, um, maybe jumped the gun a bit, but they went to see a property and they signed a contract which was unconditional and they needed an 85% loan. And then they went to see their own bank. And when the bank ran the credit report, there were some items on the credit report, and the bank said, sorry, we can only give you 80%. No problem, went through it. We got them an 85% loan with a non bank lender, and they settled on time. And they actually sent me a box of wine, which was really nice. But the really cool thing is, had those people not engaged with not just say me, but somebody like me, they would have lost their deposit. They would have been
Yeah,
stuffed.
yeah. So if people want to find what you like, find you or find out more about what you do, what's the best website that you can direct them to?
www.ilender.co.nz. And if you do that, if you scroll down the front page, you'll see a link to a radio ad which we ran a few years ago. And the point of the radio ad is just to show you that we do have a sense of humour. So, for no other reason, for going to the
Do it for that.
website, please do that. Yes.
Cool. Awesome. Ilender.co.nz if people want to reach out to you. Thanks again very much for your time just to have this conversation, Jeff. Appreciate it.
Bye.